old school, and we made a series of investments in software, and in that space, we just said, we can't have our core engineering team lead that group, because we figured they'd snuff them out. And so the challenge there was, you want to give them their own identity, you want to give them support, but you also want their, that hybrid thinking, and so you have to find a way to create a steering committee, so there is sharing going on between the classic traditional teams and the new way that we're going to think about doing things. And I think that was a little bit hard to do. It of course hurts certain people's feelings. If you have a single engineering head who's had control of the whole business, somebody saying, hey, there's this thing sitting over here, it takes some work as a team.
Yeah. And I've seen now over time kind of some of those, the bigger integrations that end up working out well of a new technology space kind of ends up becoming kind of the innovation lead for the whole organization. And then that original founder or CTO ends up being the voice of innovation for the whole company. And innovation teams do all sorts of things. Some interesting, some not. So quick question on getting back into kind of the financing topic of M&As. Anything interesting you've seen in trends for financing deals? There's the standard cash and equity packages, but have you seen anything else come up recently that's been different than in the past decade? I know we've seen some PE models pop up.
Yeah, so I'm starting, we didn't experience that other than when we'd spin a business out, the PE players would clearly be there. I'm starting to hear that, PEs that you'd think traditionally, if you think about their business models, would want to own the whole business or taking minority stakes with, I think always the idea that, hey, they'll come back and pick up the rest of the business. There's something blocks them in terms of being able to get a hold of it now, whether it's price or some other factor. So we're hearing that, but I think in our world, principally still, it's going to be debt. In our case, less often equity, but we did find we did a $1.2 billion acquisition of another public company. In that case, I thought there's just no chance they'd be interested in our stock. I didn't really want to use stock because I thought our shares, and most of us thought our shares were undervalued. But one of our financial advisors said, hey, look, price is starting to run away from you here. Why don't you try putting stock on the table? And so we did stop the price discussions. And what we found in a perverse way was the synergies that we were commonly talking about, they wanted to participate. So they wanted an equity stake. And we didn't want those shares out on the market. So we actually financed a very large term loan A arrangement with our key banks with the goal that we'd do the deal, we'd issue the shares, but we'd mop them all up. We were able to get them off the street. It was a large amount of shares in a period of about 5 months. So ultimately it was still a cash deal to us. But as is the case many times, the street doesn't understand your strategy. Our shares went down not insignificantly, and we were able to buy them back at a much better price. So the deal actually got better for us.
Yeah, that's really
I'll add something related that for us, the venture component of our business is quite active. So as corporate venture has increased in dollars and deals in the healthcare space, we've been a big part of that. And so that has contributed to doing looking at more acquisition targets where we would already be a minority owner. And we often accompany those investments with some sort of partnership relationship. So when we are at a point of considering the acquisition, we have not just the equity component, but we have a significant knowledge base of that particular company, which to the topic of how do you accelerate a deal, well, if you've worked with a company for a year or two, you have more insights than you would otherwise.
the ultimate diligence process.
Yeah.
And Ann and Dan, question for you from a CFO standpoint. Are you oftentimes the chief negotiator in the room when it comes down to the figuring out the final terms of the deal?
I mean, Dan, I'm sure you have many more examples than I do, but yeah, so we're always in that bad cop, good cop situation, and yes, I'm the bad cop.
That's where the sparring happens.
Yeah, I think, so again, it depends, I think it depends on the scale of the business. I'm sure it's very different, Jay, than where we're at. So I came into Brocade through the acquisition of Foundry Networks. So we had no corp dev team. Our CEO, at the time that Brocade approached us and said they're interested in buying the company, felt like he owned too much of the company. He didn't want to take any pressure from investors or, his mind, the SEC, et cetera. He felt conflicted. So in that case, because of our strong relationship, I end up running most of that negotiation. Of course, you're working with the financial advisors, your board, on final price decisions. But in a bigger company, I think then you have more players at the table. At the end of the day, you guys have all done modeling. We can create a model that will support any valuation, right? We just have to put a lot of energy into the assumptions, and be able to enthusiastically support them. But I think we have the role to challenge, hey, what's really going on here? Are those assumptions valid? What's the downside risk? And you're always thinking about the basic equation of finance: fear versus greed. And you're always weighing that. And you also look at the other side and say, hey, what are these guys trying to do? They have the same equation going on. They're fearful of going forward. If their model was beautiful, they wouldn't even be talking to us. And so you have to kind of ferret out exactly what's going on there.
And that's a good solicitation for mentors. If anyone wants to come and coach the startups that we invest in on financial modeling, and you want to see some ridiculous assumptions, let me know. The power of just a couple of cells can always be profoundly different, as we know. Great. Well, from a time perspective, we want to make sure that we're moving to the next session. So I wanted to open it up for Q&A. If anyone has questions for the folks we have up here, yes.
I don't have a mic, so I'll talk loud.
Oh, that's again. You're great.
Christina, you asked me a question earlier. And mine is around, so in J&J and in the pharmaceutical industry, but in many others, I'm seeing more M&A and interest, and it's a challenge, I think, for me to interact with is around data. And Flatiron and Roche's acquisition recently was very heavy around the oncology data set that they had that was very unique. But there's a dozen other examples around this. Kind of, what is your perspective on, and this is a very open-ended question, of those transactions, your interest, how do you deal with it, how do you value it, how do you find it, how do you defend it, how do you make that argument inside the company, what do you use it for, what is the value drivers, and lots of things. So anything you want to comment around data?
Yeah, so I'll speak specifically to that example and data writ large. So for those of you who are not familiar with this deal, it's a $2 billion transaction. About a year ago, Roche bought Flatiron, which is a New York City-based company. The promise of this company is that they ingest massive amounts of oncology data, and then they, through some modeling and a number of other things they won't get into right now, they're able to better predict what specific cancer therapy is going to best resolve your cancer. So that is extremely data reliant and is still a bit of a moonshot. I mean, the ability of companies like Flatiron to actually make our drug development processes more efficient and actually identify the best treatments for patients in a scalable, systemic way is not proven. So I think this is an example of a deal that actually looks very similar to some of the deals that we see on the tech side, where you're buying a capability, or you're buying an early position in a space that you think is going to be worth billions and billions and billions of dollars. I don't know that a lot of other pharma companies would have stepped up and paid that price for that company, given where we are in the proof points of it, but the deal happened all the same. To data, just more, in a more grandiose way, traditional companies like ours have a tremendous amount of data, as you might imagine, but they are not always focused on data from the end users. So we don't necessarily always know a ton about the person who's using Johnson's Baby or AccuView lenses or even the drugs. And so me and my team, there's someone else here from J&J, are actually very deliberately focused on how do we get more data, and then within our context, how do we demonstrate the value for that? And I think there are there are models that we have built that that just go back to our P&L, right? Like if we had these insights, we could increase things like adherence, or we could increase things like repeat purchases, or we could increase, decrease failure rates of our medical devices. And so, we're just trying to tie it back to these very, very big markets where we tend to have number one or number two positions, and ultimately build a financial case around that. But it is not a traditional value driver for a J&J business acquisition case, and so it's not a straightforward path by any stretch.
That's a great question.
Yeah. So this is for Anne, and I don't mean to put you on the spot, and it's kind of self-interest motivated. So I worked on the Chow deal, at the divestiture to Leguide. And just curious, when you were acquired...
I can't believe it.
Yeah, I know.
Like 10 years ago.
I know. So my question, from, again, self-interest, is as CFO and working in that transaction and receiving a divesting business from Microsoft,
Yes.
were there any aha moments that you, once we walked away?
Once you walked away.
Yeah, once we walked away.
I was going to mention, before when we started talking, I got this feeling like you got to, start repairing the roof before it starts raining. And when we started talking to Microsoft, it was just impossible to get a clear financial picture of the business. I guess because it was just too small for you guys at this point. So that was, and it just, it just took a lot of efforts then to rebuild that capability for us in Germany. With the team. I don't think there were any aha moments that we got surprised about. Frankly, we did a long due diligence, and no, I think it worked out as we planned. I'd love to chat after that.
Yeah,
this is
absolutely.
crazy. This is a deal, by the way, we did over a conference call. We never met. We were in Paris. They were here in Seattle. Yeah. And
10 years ago, you might have been at the dawn of the video conferencing. That
there was no video.
First.
But the 9 hours difference
We
was
had a
still
product.
there.
We had a product.
Yeah.
So it was a lot of late night for us. Yeah. And one of the funny things I think which may be interesting for this audience is that when Microsoft wanted to divest, it took us actually quite a while to actually get to talk to them, because we were, as a startup, just not a credible buyer for that asset. And when you guys, corporate development, looking to divest, I think it's a good idea to do the long tail of potential reacquirers, because for us it was a strategic value to buy market share very quickly in Germany that we didn't have, and that the bigger guys, Price Runner or whatever at the time, just didn't need. So yeah, so.
Yeah, that's good advice. All right, any other questions for this group? One more? Yeah.
Maybe this is one for Dan, but a lot of tech companies have a lot of cash right now on the balance sheet. So I guess how did you think about the best use of cash at the time? Like how often did you find yourself defending M&A versus like some IRR number versus like some buyback? Do you think that we've been too much about like M&A from the gut, or do we need to move towards like something more academic?
And it's interesting. So when I talk to CFO peers out there, the question of hurdle rates for investments or projects is always kind of the bane of our existence. Kind of easy to do in theory, harder to do in practice. And so I always try to boil it down to our cycle we would go through as a company. So usually almost everyone will have, hey, there's a period of time you're working on your strategy, you're updating that. You move through to products. What does investment models look like for those products to meet the strategy? And then you're putting an operating plan together where you're actually allocating capital. And so from my standpoint, it was really, the dollar I wanted to see to go to the best use. Hard, again, like I said, to always get an IRR in those. And so usually it's asking a bunch of questions about if it's not something that's going to expand market share or help scale up an existing business, be like, why wouldn't we just partner to do the other thing? let some time run, see how it develops. Because there's a lot of alternatives to making acquisition. So that's really always the questioning going through. And if corp dev guys would come in even with a minority investment, it's like, okay, well, what's your purpose there? Because for me, if I'm talking to investors, I can put that into another project. I can put it into capital equipment, or I can put it into a minority investment. And trying to figure out qualitatively, how to differentiate between those. Because again, we can set our hurdle rates, but even at a couple $2 billion in revenue, it's just not the only guide you can use.
All right. Well, thank you so much to this crew for being our kind of middle panel this afternoon. Yeah, thank you guys. Appreciate it. We will take another quick 3-5 minute